Most investors invest in companies from the United States, which is quite understandable because there is where most promising companies you can invest in are located. But good old Germany also has some promising dividend stocks to offer. You can use to diversify your portfolio. In this video, I show you 3 of the best dividend growth stocks Europe has to offer. My name is Thorsten. It's all about investing in promising companies to help you profit from sustainable growing dividends and capital gains as well. So let's go. And I made a little preparation. I added a little filter here. And the filter is called Best Dividend Stocks in Europe. What I actually did was I want dividend growth stocks to at least 10% annual growth within the last 5 years, no dividend cut within the last 10 years, stable dividends, and at least market capitalization of 10 billion US dollars, so no small caps. And I also omitted here some sectors I personally don't like that much, like banking or financials and basic materials, chemistry, such stuff I omitted. And then I did not create a ranking because it's already there. It's a public ranking and it's a public ranking for dividend growth, which means at least 1.5% to 15% of dividend growth within the last 5 years, super stable dividends payments, and the same mirrored by earnings, so super stable earnings, or at least super stable earnings, and growth by 15%. You can be extremely demanding regarding your rankings because it's not a filter, it just applies here and shows you how much it satisfies your criteria. Last criteria is heavy discount, so I want the mostly undervalued stocks. And you see we have not any of these stocks match the ranking because it's too demanding at 100%, but at least 87, 86, and 85%. This is the top 3 stocks according to this ranking, and I analyze you these 3 stocks in this video. And we have also our stocks which are very, very good ones, like Novo Nordisk, for example, Accenture, Merck, L'Oreal. You will know, even if you're from the United States, you will also know some of these companies, I'm sure. We have here the dividend matrix, right? Dividend yield, very important, and dividend increase. And you can see it that the dividend increase for the last 10 years, average 5 years, estimated it's mostly 10% upward. So this is dynamic dividend growth. So let's start with Carlsberg. Carlsberg, here you see their beers. It's a brewery and only beers are coming from Germany, but Denmark can do beers as well, and they make it very successful. You can see here the dividend growth, but let's check the dividends first. And we have here the dividend turbo, and it shows you the current dividend yield, which is 3.2%, and 3.2% is all-time high. And we have also expected dividend growth, and it means that if you buy the stock right now, the dividends, for example, should reach 3.9% at the very beginning of 26 and 4.9% even at the beginning of 27. And if we now look at the performance, how profitable is a stock if you invest in, then we start with by the year 2000, and you see that in the first years till the financial crisis was not a good investment. But then when dividend payments started, things got much better, and then you got the annual capital gains only 11.5%. And if you look at the yield including dividends, the total returns, then it's about 12%. So it's okay. I did not choose the very same day here, but just to give you an idea. So within the last 14 years, yes, the yield of this stock was higher than the general stock market. And if we go into the quality check, we can see that it's a little bit cyclical, but there is longboard upwards so they have an earnings growth, I want to say, and we have the dividend growth as well. If you add the cash flow, then you see that the dividends are nicely covered by both earnings and free cash flow as well. We have a big difference from time to time between reported earnings and adjusted earnings. And I was watching for the last business year, 22. This is due to disposal of a business in Russia. They had 8,000 employees in Russia, and due to the invasion of Ukraine, they disposed their complete business, and related to this was an impairment of close to 10 billion Danish crown, and this is why they reported a reported loss in earnings. But if you adjust this, then you see, or if you skip this because it's not typical for the business, you see that the business was running really fine in 22. Okay, let's have a look at the valuation of the stock. And here you can see that the current valuation is well below the average multiple. This is the multiple based on the adjusted earnings, so adjusted price earnings multiple, and this is just somewhere around 15, which is less than in the past where it was above 20, 24 even from time to time. And this is why we might expect that the stock can be undervalued. So let's check. We have the adjusted earnings here and the fair value based on the adjusted earnings here, based on the last 10 years, which is okay, my point of view. And then we have a current stock price of 844 Danish crown. And we have a fair value here, which is much higher currently, about 1,000. The stock already reached 1,000 Danish crown back in 2019. And now it's cheaper, although the earnings increased. And if we apply the average historic multiple of close to 19, we get a very big undervaluation of the stock and very high expected yields of close to 20% till the end of 26. But this is a little bit too optimistic, I'd say. To be more careful, you can decrease the fair value you expect in the future, and I decrease it right now to, for example, 1,112 Danish crowns, which is here, and then I calculate the expected yield, and then it's 12.4. You can even increase it more to 1,050 Danish crown, and then you still have double-digit expected annual yield of 10.6%, dividends included, and this 1,050 Danish crown is well below the stock was already back in 2020. It's the stock just before Corona crash. The stock was already worth as much as this. So I think it's a very conservative approach, and this still gives you an annual yield expectation of 10.6%. So let's go to the second stock, which is LVMH, luxury stock. And with market capitalization of 386 billion, it's number 2 in Europe for market capitalization. And this stock does not have a very high dividend, not as high as Carlsberg at least. It's 1.7%, and 1.7% this is right here, and it's somewhere in the average. We had a special dividend here, but we not long ago the dividend was even below 1%. So we have not only dividend increase, but maybe also kept some capital losses or a correction of the stock. Let's check here. Here is the correction of the stock, and if you look here, what to expect from investment in LVMH, we see that we had a lackluster performance. But starting from 2000 to 2009, it's about the same, which was true for Carlsberg. But then things changed much for the better, and then we had just capital gains of close to 18% starting in late 2009. And I can also add the total return here, and then it should increase a little bit. I try to get about the same date. Yes, okay, now it's September anyway, and then you have close to 90% annual yield. Most of the yield you get with this stock is by capital gains, but we have also, you can see it here, nice dividend growth. And as I said, here are the metrics, about 15 to 20% dividend increase year by year when you start with 1.7%. And if you look at the quality check, then you can see that here are much more stable earnings even compared to Carlsberg. We had Corona during the Corona crash when the lockdown was and the trade-on or channel was not available anymore because bars and everything like this, restaurants, was closed. We had here earnings decrease, but still no dividend increase. And right now, nicely covered dividends by both fresh cash flow and earnings as well. And if you look at the multiples, we see that here in the very near future, stock is already undervalued. And this should also translate. And here we see a correction again. In at least a fairly or undervalued stock, we use the adjusted earnings once more, and then we zoom in. And what we see here is that we have a slightly undervalued stock already. After this correction here, the stock was overvalued when the stock cost as much as 900 euro, and now the stock price fell to 700 euro. And we can just look at the expected yield, including dividends, and this is close to 14% already. Annual expected yield till the end of 26. What we can do here is also we take a little bit more conservative approach. I would take these helper lines here, and for example, if you go to the all-time high in the year 26 or about the all-time high, you still get the expected annual yield of close to 10%, 9.4% here. And we have a very stable stock or company increasing their both earnings and dividends as well. So it's already a conservative approach. So I think this is also a nice stock to invest in. And the third one, many people won't know, is Wolters Kluwer. Wolters Kluwer, they are a publisher, or they have been a publisher, they are still a publisher, but they are also a software company right now because they focus on software when they publish something, and they are always publishing software to help people somehow in their business, but also private life. For example, they publish tax software to help you make the tax declaration, and I use the software from them for more than 10 years already. I'm really happy with this. I'm not happy paying taxes, but I'm happy that making this tax declaration is not so hard when you use their software. They are also in other domains, like we see it here in the segments, governance, risk and compliance. So they are also for businesses, legal and regulatory stuff. This is my phone. I forgot to turn it off, and other things as well. So now I would say let's go to the analysis. Current dividend is a little bit lower. It's 1.5%, slightly below LVMH. This is in the past you got even more, but unfortunately the market got aware that this is a highly profitable and promising company, so the stock price was sent up again and again. If you look at a very large distance, and you also see that from 2000, here in this case until about 2012, the performance was lackluster of this stock. It was even negative, but then starting in around 2012 or somewhere earlier, then the stock really hit its big turnaround with annual yield for more than 10 years already, average annual yield of more than 20%. So it was a really good investment. This is without dividends. If we add dividends and make about the same period again, we get even close to 24%. And no end in sight. So the business is really running well. And you see here that while in the first decade of this millennium, the earnings were not able to increase considerably. Dividends at least were paid and not cut. Then in the next decade, starting from the next decade, things really took off. And now check at the valuation. As you can see here, stock price increased, and we also have here expansion of the multiples. And I'm afraid that the stock is a little bit expensive right now. Let's check. Here we see impressive earnings growth. And of course, the stock price increase is justified in partly by growing earnings. But unfortunately, you can see it here. The stock price grew more aggressively than the earnings grew. And now we have an overvalued stock. But maybe we should make an adjustment here, because it is a very profitable company, and the earnings growth rate, the expected earnings growth rate is already in double digit. It's about 10%, at least for the next 2 years. And there we should even have a 20% increase, but I don't take this for granted, because that's the glass ball is here very much. And if we increase from 19 to, let's say, at least 25, which is already a little bit aggressive, then unfortunately we still have a low expectation of the annual yield, including dividends, of just slightly below 5%. And this is not enough in my point of view. So I would say we need to wait for the stock to correct somehow on a level maybe of about $110, and then your expected yield would be at least double digit with 11%, or even a little bit below, let's say to $103, then your yield should be at least close to 14%. So this is a stock where I would wait for a correction, and I would recommend to end up a buy limit here, which is, let's say, around 103, 104 $, somewhere around this, and then wait for the stock to correct. Of course, there are also other stocks you can invest in. You can check this for yourself. And I hope that one of these 3 stocks at least sounds interesting enough for you to dig a little bit deeper. If you want, you can also drop a comment below. If you already invest in dividend growth stocks, just drop them below, and I will be interested to see what stocks you already chose. If you want a stock to be analyzed on this channel from Europe, but also from other parts of the world, you can also drop a comment below. Okay, thanks for watching. See you next time. Bye-bye.